Good morning. Time for another wonderful day of business finance here in north central Montana. Got a little snow, a little cold going on, but the snow's always good for the ski hill. You can see ski hill pictures on my computer there, so hope you enjoy those. We have moved on to chapter 6, so we'll talk about chapter 6 today in this video, and then a little later I'll also do a video again proceeding on project 1. So let's go take a look. Chapter 6 actually isn't the longest assignment. We've got 4 or 5 questions on there, I think. 2, 4, 7, 8, and 12 if I'm not mistaken. And again, my computer slows way down. Shame on me. I didn't stop everything else, so I'll try to maneuver this thing. I'm going to pause it for a second and go stop some stuff. Okay, so we'll give this another try. Hopefully I didn't swear too much while I was trying to shut things down that showed up maybe on the recording. Sure hope not anyhow. Sorry here again, we got to get a couple more things going. So you guys have just 2, 4, 7, 8, and 12 due for this particular chapter, and so I did again similar ones, and I picked a number 1, which should be similar to your number 2, and my number 1 reads like this. It says Gary's Pipe and Steel Company expects sales next year to be $800,000 if the economy is strong, $500,000 if the economy is steady, and $350,000 if the economy is weak. Gary believes there's a 20% probability the economy will be strong, a 50% probability the economy will be steady, and a 30% probability of a weak economy. What's the expected level of sales for next year? So really all we're doing is taking, I don't know, I guess I'd call this kind of a weighted average, and that's all we're doing. And so you can see how I set up the problem. Again, if we take our time and set it up well, it's a little bit easier, I think, to come to our proper answers. So we've got strong sales, 800,000, steady economy, 500,000, weak economy, 350,000, and I put my probabilities in here. And remember, I've got to enter those as like 20% is going to be 0.2, okay? And 50% is going to be 0.5, and 30% will be 0.3. Okay? If I don't get my decimals in there properly, and then if I want to change, my decimals, I can do that, up here, right? Or I can change it into a percent by clicking this up here. So then all we have here is I've just labeled it S times P, or my sales times my probability, and that's just going to be this column times this column. And so we hit equals, left click on that, hit my asterisk for my multiplication, left click on this one. I've got it in there now. Okay, so that's 160,000. I could repeat that formula. I can also just drag that formula down. Okay, grab that corner there so that little cross appears, drag it down. I get the same formula then, 50,000 or 50% times 500,000, which is 250,000, etc. I may want to put a little bottom border on that just so I got a nice line there. But then to figure out what my weighted average, for lack of a better term, is, I just click my sum and I sum up these 3 figures. Do it for me, $515,000. And looking at the numbers, that makes sense, right? I mean, steady is 500,000, 50%. That's kind of my biggest probability right there. And so the fact that I'm sort of close to that makes some sense to me. So I think that's a realistic number. Okay. Move on. You guys have number 4, and so I did number 3, which is very similar, and we look at a couple different things on this. But 3 says Tobin Supplies Company expects sales next year to be 500,000. Inventory and accounts receivable will increase 90,000. So we've kind of had things like that before, right? To accommodate this sales level, the company has a steady profit margin of 12%. So profit margin of 12% means 12% of our sales, with a 40% dividend payout. How much external financing will Tobin Supplies Company have to seek? Assume there is no increase in liabilities other than that which will occur with the external financing. Okay? So they give us a lot of variables, and I just more or less put them in, right? I decided that I'd put my sales up here because they've said that. My profit margin is 12%, so again I entered that as a 0.12. Okay, so my profit, okay, this is my profit margin percentage. My net profit, I guess you could say, is equal to my profit margin times my sales, right? So my 12% times my 500,000, so that's 60,000. I'm going to pay out 40% of that in the form of a dividend. Okay, about 40% of that in the form of a dividend. A lot of companies do that, right? A lot of them will have a set percentage like that they at least shoot for. Okay, so in this case, it's going to be equal to 40% times my profit, which was $60,000. So I'm going to pay out $24,000 in a dividend. So now I have to calculate what my cash flow from my operations is. Well, it's my profit minus my dividend payout. Okay, so this is simply equal to my profit minus my dividend payout, or $36,000. Okay, so I've got a positive cash flow of that, right, of $36,000 from operations. Cash flow from operations is what that means. But I've also got to increase my inventory and my accounts receivable. I don't know, does it specifically say those? Yep, inventory and accounts receivable are going to increase by $90,000, which is going to have a negative effect on my cash flow. And I probably should have entered this. It would probably be more appropriate to enter this in as 90,000 negative, right? Okay. But then I have to redo this. So I've got a cash flow from operations as a positive 36,000, but I have to increase my inventory and accounts receivable, which has a negative impact on my cash, right? Because I'm going to increase, I have to pay for more inventory, so cash goes out. You know, it's just a trade of assets really, but I'm trading cash for inventory, but it certainly decreases my available cash, as does an increase in accounts receivable. So I'm allowing more customers to charge their purchases, and that also decreases my cash. So I've got a positive 36 and a negative 90. This will, I can just sum those two. I just want to get these two. And I end up with my financing needs are $54,000. I would have a negative cash flow of $54,000. Would I go to the bank? Would they lend me that? Yeah, reasonably good chance that they might. Right? There'd be a reasonably good chance. I don't know enough about the other company and what its assets and liabilities are and those things to tell you for sure, but there's a reasonably good chance they would. So, okay, then you guys have 7 and 8. I'm sorry, and I did a couple of them, okay, that are like 7 and 8. So you know, this my first example's up here. I think more like 7, and my second example down here is more like 8. And I just used different amounts, different interest rates, different total amounts. So your guys' 7 is Boatler Used Cadillac Company requires $850,000 in financing over the next 2 years. The firm can borrow the funds for 2 years at 12% interest per year. Okay. Mr. Boatler decides to do forecasting and predicts that if he utilizes short-term financing instead, he'll pay 7.75% in the first year, 13.55% interest in the second year. Determine the total 2-year interest cost under each plan. Which plan is less costly? And again, your guys' numbers are going to change, but I just did 500,000, and for you guys, you know, the amount's the same each year. It's just 850 instead of 500,000. Okay, I kind of used more realistic interest rates based on today's interest rate scenario. Okay, And I said if I was going to finance that $500,000 for 2 years, okay, I would probably be able to get a locked-in rate of 5.25%. Okay, and so I put in my amount, I put in my interest rate, and again, my interest rate I have to enter is 0.0525. Right? 0.0525 is equal to an interest or a percent of 5.25%. I do that for both of these. Okay, then it's simply a matter of calculating what my interest would be each year, and that's simply my interest rate times my amount borrowed. So I just click my equals, take my interest rate, left click on that, my asterisk, which is my times, and then my 500,000, and I get 26,250. Again, I can drag that. I end up with the same amount both years, which makes sense because I have the same interest rate each year. Okay. This assumes, of course, no compounding of interest and those types of things, which you typically would be required to pay this interest at the end of each year. Okay, now I just need to total that. And a couple ways I could do that. I could say this is equal to this plus this, or I could have used my sum feature up there as well. Okay, either or. Now in my second scenario, same amounts again each year, but first year I might be able to get a little lesser interest rate, and second year a little more interest rate than what I paid here. So I need to calculate that and see which might be the better option. And so again, I just enter my amounts. I enter my interest 0.0425 and 0.0675, and my interest that I'm going to pay then again is simply equal to my rate times my amount, 21,250. I can drag that formula down, or I could do the same formula again here, right? My rate times my amount. Okay, so I'm going to pay 21,250 the first year, and I'm estimating I'm going to pay 33,750 the second year. And again, I can total that, and I get $55,000 in interest. So really, under this scenario, okay, getting the steady interest might be the better option. If you guys need to answer that, then in my example anyhow, getting the steady interest would be the best example. But whichever's the lesser interest would be the more important, right? You want to pay least or less interest if you possibly can. Okay, then question 8 says Biochemical Corp requires $550,000 in financing over the next 3 years. The firm can borrow the funds for 3 years at 10.6% interest per year. The CEO decides to do a forecast and predicts that if she utilizes short-term financing instead, she'll pay 8.75% in the first year, 13.25% interest in the second year, and 10.15% interest in the third year. Determine the total interest cost under each plan. Which plan is less costly? Okay. I maybe have an extra step in here that I don't need, right? Because what I did here is I picked year 1, 2, and 3 at 6%. It's really just like the one that we just did, except we're adding another year. Okay. And then I've got a years 1, 2, and 3 here. Okay. Just want to make sure that I'm reading the problem. Yep. And I just got different amounts. Again, I've got 250,000 as opposed to the 550,000 that you have, and I used 6%. You can probably ignore this middle set of numbers. In fact, I'll just do this. We'll just hide those. Okay. And so if I use the 6% each year, right, for the full time frame, just like I did up above, I enter my amounts, enter my interest rate is 0.06. Okay, 0.06, 0.06. Multiply my, this is equal to my rate times my loan amount. And I can drag that formula down. I can do my sum, and I get 45,000 if I do it that way. Now, if my rates are going to vary a little bit, and my rates here maybe aren't as realistic, I'll try to put in some numbers that are maybe a little bit more like theirs. Let's say I had interest the first year of 4.5%, 0.045, and in the second year we're going to predict that it goes up over the 6%, similar years. So 7.25, 0.0725, just 7.25% interest, and then that last year it's going to be pretty close. So we'll do 0.0615, 6.15%. Okay. You see, because I had things entered, it actually did the calculations for me. Okay, but again, it's just my rate times my amount. So my rate times my amount equal to my rate times my amount, and I could have drug that down, and I still can for the last one. Okay, and then I just sum those interest amounts up. Okay, now in this case, my second scenario actually came out to be just a hair less, $250 less than my first scenario. So now you'd have to ask yourself that question, since it's so close, is it worth the risk? Because this might be locked in for all 3 years, and this is you're making some assumptions, right? What if rates went up this third year to 7.25 or 7.5? So what's nice about setting up these spreadsheets actually is you can do those what ifs. What if this went up to 7.5, 0.075? Boom. Then I'd have a $3,125 more in interest. Okay, maybe that's worth the risk. Those are the things that are kind of neat to do with spreadsheets, just to be able to figure these things out. I just put that back to that original amount. Oh, what did I do? 0.0615. There we go. Okay. Then lastly, you guys have number 12, and again, there wasn't a sample problem that was like it, so I just went ahead and did basically the same problem, but I changed the amounts and the rates. So 12 says this. It says Coulter Steel has $4.2 million in assets, and it breaks down those assets. You got temporary current assets in your problem of $1 million, permanent current assets of $2 million, and fixed assets of $1.2 million. So short-term rates are 8%, long-term rates are 13%. Earnings before interest and taxes are $996,000, and the tax rate is 40%. And I used the same tax rate, but I kind of changed everything else. So, okay. It does say this. It says if long-term financing is perfectly matched or synchronized with long-term asset needs, and the same is true for short-term financing, what will earnings after taxes be? So you do have to go back, and it says to go back and look at the figure 6.5. It'll take you back to the right page. I think that's on page 169. So if you look at 169, it says that, we're going to use long-term financing to fund all of our permanent current assets, and of course all of our fixed assets. What would be a permanent current asset? A lot of companies, especially as they get going, they have a relatively steady inventories, right? XYZ clothing company, it's going to have a relatively steady inventory. Kind of comes and goes every month. They have sales, of course, and they get rid of inventory, but then they have to restock, and so that could be a permanent current asset. So could accounts receivable. Accounts receivable may be even more steady than that for a lot of businesses, because they just have customers that charge on a regular basis, and they collect 30 or 60 days later. And so they've just got kind of, and you'll see this with companies over time, they build up basically a base of permanent current assets. And so those are the type that you might fund. You might actually fund them on a long-term basis. We usually said in the lending industry we liked to match our loan terms with the loan type. So if it was for current assets, you'd want a short-term loan, right? If it was for longer-term assets like real estate or equipment, then you'd have a long-term loan. So these are kind of in the middle, right? These are some of those current assets, what you'd normally call current assets, because they could be converted to cash within a year, but they're kind of permanently on the balance sheet, and so they could be financed conceivably, at least, with long-term debt. Okay. So I changed my amounts. I just said I had 200 in temporary current, 150 in permanent current, and 800,000 there. And I did a total. Your guys' total was what, 4.2 million. My total's $1,150,000. Okay. Then I put in my rates, and I used rates that were a little more contemporary, I guess I would say. Books back in the 80s, rates were nice and high, or maybe even early 90s, but You know, in today's day and age, probably a short-term loan, I've put it in as 5%. More long-term loans, okay, and we use long-term financing even for these permanent current assets, I put it 7%. And I just kind of made those numbers up. I didn't call my local bank or anything. And then just like we've done before, I want to calculate what my interest is per year, and that's just simply a matter of taking my rate times my principal amount. And I get 10,000 there, and I can drag that down, so I get 10,000 there. 7% times 150,000 is 10,500. 7% times 800,000 is 56,000. So my total interest is just the sum of these. Right, sum of those three. That's the interest that I'll pay per year for this type of a debt structure. Okay, then it tells me, or it tells you guys, that you have $996,000 in income, and I made up a number. I just said, well, if I have $180,000 in earnings before interest and taxes, or EBIT, we call that, is fairly common mnemonic, I guess, EBIT or EBIT, that we plug in there. I used $180,000. And then I said I wanted interest expense. I got earnings before interest and taxes. Well, let's deduct our interest expense, because that's going to give us our earnings before taxes, right? And so I simply came here and I said this is a negative of my interest, my total interest up here. Okay, 76,500. So I've got 180,000 in earnings before interest and taxes, 76,500 in interest, and so this is equal to my earnings before interest and taxes minus, but I've got this entered as a negative number, so I'm going to have to use the plus sign, right? And that's when you subtract, or when you add a negative number, it's just like subtracting. So I end up with earnings before taxes of 103,500. Now I got to calculate my taxes, and they say my taxes are at 40%. I plugged 40% just over into another column over here. You can. Okay, so I pay taxes on this earnings before taxes, right? Because interest expenses are deductible, so I pay taxes just on this amount. So to calculate this, I'm going to use a minus because I want it to come out as a negative number, because taxes are a negative number. So minus my tax rate times my earnings before taxes. So I end up paying $41,400 in taxes. So I've got my earnings before taxes, basically subtract my taxes, and so I get my net income is equal to my earnings before taxes. Again, I have to use the plus sign because I've got a negative number there that I want to subtract, really. And so I end up with $62,100 would be my net income, using the same basic structure that you guys would use to figure yours for number 12. So that should be it. Not too long, relatively short assignment, thank goodness. And so I'll get this one sent out, and I'll go to work on another one for project 1. Thanks, and have a